Good afternoon. Welcome. You're watching MF Corner and I'm Sumera Abdi joining you live from my home this afternoon. On the show today, we're going to talk about FMPs or fixed maturity plans. What are the pros and cons and should you lock in yields in a falling rate environment? DP Singh, Chief Business Officer at SBI Mutual Fund will join in. And a little later on the show, we'll talk about is there a right time to sell your mutual fund units? I mean, what should be the circumstances under which you should press exit? Santosh Joseph of Germinate Investor Services will join us. But first up, let's talk about fixed maturity plans, FMPs. Now, what are these exactly? They are debt instruments which have a predefined portfolio at the beginning and they have a fixed tenor, okay? So these are hold to maturity, instruments and they are closed-ended. So what does that mean? That every investor in a particular FMP gets in at the same time and gets out at the same time. There is no in between, So DP Singh, the Chief Business Officer at SBI Mutual Fund now joins in. Hi, Mr. Singh. Good afternoon. And thanks very much for joining in. My first question is the one out of curiosity because, off late we have heard news that, FMPs were getting rolled over. There have been instances in the past where this has happened, which is, to my mind, breaking the sanctity of the fixed maturity plan, right? In one case, we even saw some, one of the AMCs announced that there would be a rollover and then, it was redeemed at the right time. Under this situation, I'm just curious, what is, the compelling reason to launch even more FMPs?
The FMPs as a category is something which is very, very close to any fixed coupon product in the market, like FDs or company deposits. Now, this is a capital market instrument. So definitely, since it's a capital market instrument, it attracts the taxation also like the capital market product, like long-term capital gain, short-term capital gain, so on and so forth. And so for this reason, this is very, very important that we have to understand that why and how these are why these are being launched. You talked about rolling over. The rollover happened, or it was attempted because some of the securities where those fund houses locked in their securities, they were not getting it encashed at the time of redemption, at the time of the maturity. So that was an issue. But the FMPs which are being launched now by SBI Mutual Fund, we are putting most of the money into the either government securities, state development loans, or AAA rated very high quality securities, where the maturity amount is more or less. We know that there will not be a problem. So that's the quality of the debt instruments which are there are of utmost importance. That's what makes the difference.
Okay, fair enough. The other question is that, FMP season is considered to be this, late Feb and the whole of March sort of time frame. And, just a note for our viewers why FMP season is considered to be, specifically this month of March is because by investing in an FMP in March, the duration of the FMP is managed in such a way that the redemption, or suppose a 3-year FMP, the redemption will come in the April of the 4th year, and therefore you get one extra indexation benefit. So by investing in an SIP FMP of 3 years, you will get 4 indexation benefits, and that has been one of the selling points. So Mr. Singh, what would be the case then to launch FMPs in the rest of the year? I mean, wouldn't an investor prefer to just wait it out?
No, we are just in the month of May. See, as you said, this is one of the selling points. That's not the only selling point. Okay, if you are putting money in March and getting redeemed after 3 years in the month of April, definitely you will get 1 more year's indexation benefit. But it doesn't mean that the indexation benefits itself loses its sheen if we are not getting 1 year extra. For example, the FMPs which are being launched now, we look at the curve at which level the yields are attractive. For example, now at this point of time, 4 to 5 years yields are quite attractive. See, today FD rates are generally between 5.5%, but we can get very high quality securities like SDLs at 6.25%, at that part of the curve, 4 year plus and 5 years kind of thing. So we are logging the yields at that point of time, and see, still if it is for 4 years, you'll get 4 years indexation. That is also very, very attractive. Doesn't mean that if you're not getting 1 year extra, so it will not be attractive. And second, see, we feel that there's a market for at every point of time. If I have liquidity today, I will not wait till March. I don't know what will be the yields at the in the month of March. It could be lower, it could be higher. So I have to park my money today. I have locked my yields today. So I have to do it. And there's a niche. There's definitely a big niche who wants to log money at any point of time.
Okay, fair enough. But what about returns? I mean, considering that this is, after all, a closed-ended product, would it offer anything significant over, say, investing in a liquid fund or an ultra-short duration fund? Or is it just that because the expectation is that, it's a falling interest rate scenario, the FMP would score in any case?
Definitely. See, liquid fund is not for the 3 year plus. It's not a 3 year plus product. And the yields on liquid funds today are ranging between 3 to 3.5%. Same is the case in the case of ultra short term. It will be 3.5 to 4, 4.25, 4.3%. Those are kind of deals. But if you look at the curve of 4 to 5 years, the securities are available at 6.2, 6.25, 6.15% kind of thing. So there's a huge gap, almost 250 basis points, 250 to 300 basis points. And then over and above the tax efficiency, after 3 years, you get the indexation. The way inflation is going now, if we suppose we close the yields, we lock the yields at this point of time, and the way inflation is, and presuming that inflation remains at the same level, so whatever you will get in the post-tax return, it will be almost be tax-free, because whatever you will get adjusted against the inflation. So that's the biggest benefit. And the gap between the funds you talked about, liquid and ultra short term, there's almost 250 and 300 basis point difference. That's huge, almost 100% difference.
Okay. Which kind of an investor would you target with an FMP?
See, anybody, any HNI, ultra HNI, anyone who is into the tax-paying category, the much better for the people who are in the highest category. So even if you are having a 30% tax bracket, even then 30% is huge, because it becomes very, very tax efficient. There was only one disadvantage of putting money in FMP. That was the liquidity was not there. Whereas in case of bank FD, liquidity is very much there. Of course, in company FD also it's the same thing. But today, each and every bank is ready to give a loan against FMP at a very, very low rate. So that part is also taken care of. So FMP becomes very, very, for anybody who doesn't want to have the volatility of yields, volatility of markets, interest rates going up and down. For them, anybody is a very, very good product for everyone.
Okay. And finally, Mr. Singh, in the past, we have seen a lot of, maybe advisors or distributors selling FMPs, comparing it to a bank FD. And, this is a myth which has been busted several times over, right? In your opinion, is it a fair comparison at all?
It is a fair comparison, but at the same time, one has to understand there are no free lunches. I mean, as far as mutual funds are concerned, there will be a bit of risk. We have to measure the risk. What risk is there? The risk is of the liquidity. Risk is of default. But since it depends which kind of paper you are putting in. If we are putting money in only in government securities or state development loans, then definitely there's hardly any risk. There's no risk. Then it's definitely unfair to compare it. But if you are putting money in corporate paper and corporate defaults, well, mutual funds are pass-through items, right? So but then the default will be passed on to the investor. But again, that coming to the same point, when the risk mitigation is something which is the responsibility and duty of mutual funds. Whatever we are saying, if we are saying that we are putting money in SDLs, that we have to walk the talk, we have to do the same thing what we are talking about. And see, SBI mutual fund, in our fund, we generally see that a lot of retirees, a lot of the people, they have got good faith in the brand SBI, and they see we have to live up to the reputation. So we will never ever do something which kills the reputation of the organization. So walking the talk, and moreover, the regulator is also very conscious now. They don't allow other. There used to be leeway that you can put money in this security, that security. Now, today, if I am filing for the approval of FMP, I have to clearly articulate that which kind of securities will be put in, so that when I put it on offer, I have to tell that these are the securities which I have going to put in money, so that the investors are aware upfront that which kind of portfolio is being managed for, or is being made for this particular FMP. So that's something which has happened in the recent past, and which is very good from the investor point of view.
Mr. Singh, thank you very much for your time this afternoon. So, two key takeaways on FMPs. One is that not all FMPs are created equal. And like Mr. Singh said, that the portfolio itself is predefined, it's in the public domain. So please do your due diligence and don't blindly invest. After all, any kind of mutual fund is subject to risk. With that, a very quick break. On the other side, we're going to talk about, is there a right time